It's time for In the Money, stock market action on AM 820 News. Here's Chief Market Strategist Gareth Soloway from InTheMoneyStocks.com.
Good afternoon, everyone. As always, a pleasure to be with you as we divulge more Wall Street secrets and debunk more investing myths, helping you to profit in any market, up or down. I'm here to be the pillar of truth, revealing what Wall Street does not want you to know, while giving you hardcore analysis on stock market, in trends, as well as individual stocks that can make you money. And that's, again, what it's all about here, folks, as I come to you every Sunday. Today we have some great football games. Looking forward to them this afternoon. But before we get in that, let's figure out where and when and how to make money in this market. And again, I've talked to you guys over the last few weeks about various shady practices on Wall Street. And again, this is stuff that the media doesn't cover. This is stuff that for sure Wall Street's not going to just be talking about. But it's things you need to know so that you can avoid the pitfalls. So you're not going to fall into these traps anymore. I think it's at that point where we as individuals have to stand up. And yes, maybe it's tough for us to put a stop to them. We're only one person, or together we're a group. Maybe at that point we can. But at least let's say to ourselves, no more. No more for me. No more falling into these traps. All right, so that's what I really look to accomplish in these radio shows here in the Money Stock Market Action. Again, my name is Gareth Soloway. I'm the Chief Market Strategist at InTheMoneyStocks.com, and it's really a pleasure to be here with you every Sunday. All right, number one, before we get into some of the crazy, shady stuff going on Wall Street, I want to recap last week. Let's take a look back, and I'm not going to tell you what you heard on various news outlets about last week, market up or down, nonsense. I'm going to tell you what the pros see. What do we see in the underlying market, and not what Wall Street is trying to tell you so you believe other things. All right, so number one, just looking at the market last week, generally we had a down week. All right, it wasn't a big down week. It was a very small down week, but the S&P 500 did end lower on the week. All right, knowing that, what does that mean? Well, the first thing we have to recognize is options expiration. All right, that's what last week was. And options expiration is the third Friday of every month. And that's when a majority or these options contracts that are sold to generally the public expire. And just to briefly go into what options are, because I'm sure there are a lot of you out there that do not know what options are. Options are essentially you're guessing. You're going to buy an option, and you're going to buy an option on, let's say, Microsoft at, let's bring up the price on Microsoft here so we can get you a accurate reading here. All right, so Microsoft on Friday closed at $36.38, down 51 cents on the day. Now, just a heads up that Microsoft is reporting earnings, I think, next Wednesday after the close. But in any case, let's say you feel like Microsoft is going to go up, but you don't have a lot of money. All right, so what you do is you go in and you buy options, and options cost very little. All right, you can buy an option on Microsoft for, let's say, $5 an option, and generally you'll buy 100 or 500. I mean, you usually buy them in 100 lots or whatever. But the point is, the bottom line is, you're buying a very cheap way of getting into a stock, either long, which is going up if the stock goes up, or short if it goes down. And you can bet either way. You can buy puts or calls. Calls mean the stock would go up and you would make money if you buy calls, and puts, if the stock goes down, you make money when it goes down. All right, now the key here is to recognize where the shadiness comes in these options expiration points. All right, if I just look at my list right here, and I just bring up my list of closing prices on various stocks, I noticed something strange on Friday. All right, I noticed that Boeing closed right around $140. Baidu, B-I-D-U, closed around $170. Google closed at $1,150 approximately. Apple closed at $540. Amazon closed just under $400. Now, let me just ask you this. Does it seem a little weird that all these stocks are closing right around these even numbers? I mean, Friday's Friday. I mean, it's no different than the previous Friday or the Friday of next. But for some reason, these stocks are closing around these key levels. All right, let me explain what's going on here. So really, what happens in the options market is every month, the institutions, these big banks, they sell a majority of these options contracts to individual investors like you and me. All right, and what'll happen is you and me buy them because they're cheaper. I mean, well, we think they're cheaper, but what we don't recognize is that it's kind of a scam, but that's another story, and I'll get into that in a minute. But the point is we buy them because they're a little cheaper. The average investor who may not have millions in the bank says, oh, you know, I can be on the buy side of Microsoft, or I could be long Microsoft by buying these options contracts for, you know, $100 or $200, and then I can make a lot of money. I could double my money if it just goes up a couple dollars. And that's what options are. And again, options are a high-risk strategy. And I stress that, folks, because I'm not a believer in options. All right, now options can be traded by individuals well, but you really have to know what you're doing because they expire. And this is where the institutions get you. All right, so anyways, let's say I buy a $37 call on Microsoft. All right, so basically what I'm doing is I'm buying a contract on Microsoft for, let's say, I don't know, we'll say $500. And ultimately, if it goes up a couple dollars, I can double my money on that, maybe even triple my money. So I can make on $500 maybe $1,000 or $1,500. All right. Now, the key is if my call is at 37, that's my strike price. That's what the call you're buying. When you pick it up, you pick that level on a option. You have to pick a level that you think it's going to go above or below. And remember, calls, if I'm buying a call, it's going above a price. If I'm buying a put, I want it to go down below a price. So I could buy a put at 37 strike, which is the level I want it to go below, or I could buy a call at 37 strike, which I want it to go up above 37. All right, in any case, the point is that I only will make money if it goes above that. And remember, I paid a premium to get into that. Well, who pockets that premium? Well, the institution. Now, the institution has to pay you out if it goes above 37. All right, so if I'm buying a call at a strike price of 37 and it goes above, okay, if it goes above that level, let's say it goes to 39, well, I make a lot of money and the institution loses money. So wait a minute. So you're telling me the institution could actually be on the losing side of a trade here or an investment? Well, that doesn't seem like Wall Street. Wall Street usually makes money, and they make a ton of money. So wait a minute. So when I look back and I tell you Boeing closed at this price and Google closed at $11.50 and Apple closed at $5.40, is it possible they could be manipulating stock prices going in to options expiration Friday where those contracts expire to purposely mess and screw over the little investor? And I'm going to tell you this right now. It happens. All right. This is why if you're ever going to play options, I strongly advise against holding them into options expiration Friday. Because literally what will happen is Microsoft, I may be in the money on my Microsoft call throughout the week, and then all of a sudden, just on that Friday when this contract expires and I either get paid out or I don't, all of a sudden Microsoft goes down below 37. And I scratch my head as an average investor, and I don't understand. Oh, man, I was in the money. I was almost doubling my money. But all of a sudden, on the last day, it just got pushed down. And ultimately, folks, that is what's going on out there. So options expiration was last Friday, and when I tell you about these stocks closing at these even numbers, what's going on behind the scenes, these institutions have these mega computer programs. We know about them, high-frequency trading programs and everything else. They have billions of dollars to spend on these things, and they make billions and billions, tens of billions, hundreds of billions off of them over the course of the lifetime of the program. Anyways, what's going on is stocks are being pushed to a strike price. So like, for instance, Microsoft, if I buy 37 calls, if the institution in their computer program, if the computer program says this computer program here is telling the institution they maximize their profit if it gets below 37 or right to 37, that's where the stock price generally ends. All right, and what happens to me? If I bought that call, it expires worthless. I lose that $500 I spent or I tried to invest. It just goes away into thin air. You lose it all, 100%. All right, so when I look at Google at 11.50, what does that tell me? Well, it tells me that probably into the end of the day, onto Friday's expiration on Friday's Options X, most likely institutions said, where are we going to maximize profit here? Well, most likely, if we can close this thing around $1,150 a share on Google, we're going to maximize profit. Well, okay, guys. Well, let's see. How much is it going to cost us to push that stock down? Okay, it works out. We make, $10 million. Done. All right, so again, folks, as I get into this program a little bit more as we get into our first segment break here on In the Money Stock Market Action on 820 AM News. I want you to be aware of what goes on. And I'm going to divulge more secrets. We're going to get into last week's market action. But right now, we're going to take a break and come back in about 2 minutes.
Here's Gareth Soloway with more In the Money Stock Market Action on AM 820 News.
All right, guys, back here with me, Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. Before we get into another segment on various things going on in the market, and I'm going to go over some key trades that I think in this coming week are going to be very, very beneficial. But before we do, I want to just remind you, you can call in or email me, and I will do my best to answer whatever questions you have on the market. And just a reminder, you can have a question on a stock, you can have a question on the market, you can have a question or a statement on an experience you had in the market. Anything you want, you can come to me, and I'll do my best to help you and let the whole world hear your experience out there. All right, so again, the number is 866-977-4820. That's 866-977-4820 here on 820 AM News Talk Radio. My email, Gareth, Gareth, at InTheMoneyStocks.com. That's InTheMoneyStocks.com. All right. Just going back to what we were discussing briefly before, the options market, I want to make sure everyone understands it's not that options are a total shady mess, all right? You can do options if you understand what you're doing and as long as you understand the end game on options expiration, all right? Because I know a lot of people out there that do play options and they play them very profitably. But again, what the problem generally happens, and this is generally in the whole entire market, is that the average investor who works 9 to 5 and makes a good living working hard, they just don't have the time to learn this stuff. And that's where I come in. I want to make sure you understand. I want to make sure you understand that if you're dealing with your financial future, you really do have to put a little bit of time, not a lot of time, but a little time in to at least learn the tricks of the trade. Because, again, there's nothing worse than getting caught off guard where you're in an options contract, and, again, going back to, let's say, Microsoft or Google, and you're in the money, and you're saying, oh, man, this is great. I'm going to make, 30% of my money on these option contracts in a week or in 3 weeks or whatever it may be. And then just like that, you notice that it just gets taken away from you. Instead, you could have sold it the day before and just pocketed that money instead of risking it. So just be aware of that. Just again, that's all I ask. I really, truly am here to help and make sure that each and every one of you gets that inside track that Wall Street does not want you to know. All right. Now, let's go over again last week. So last week, we had the market trading slightly lower. The one thing that I need you guys to understand, and this is something that I stressed on my short radio segments on 8:20 a.m. throughout the week, and just to refresh, I'm on at 8:53 a.m. In the morning, okay? So 8:53 in the morning before the market opens, and 5:53 after the market has closed. And I do about a 3-minute segment giving inside information on how to trade the market for that particular day or the next day. What do you need to look for? And one of the things I stressed in multiple segments last week was the S&P 500's inability, and this is huge, to close at a new all-time high. All right, so let's just go into the charts here, and I'm bringing up my charts as we speak. I would love it if some of you guys are able to bring up the charts. And I think one of the things I've been talking about with my business partners at In the Money Stocks is whether or not we want to have live charts that you can tune into while I'm on the radio. We'll see again if we can have that, going in maybe a month or two. But I think that would be a big benefit to each and every one of you. If you're in the car, it's a little harder, obviously. But if you're home and listening, you can easily tune in and see the charts that I'm showing you, and I'll be pointing things out and so forth. In any case, the S&P 500 last week made a new all-time high intraday. Now, intraday means between the market open and close. So at some point, it popped above the December 31st high on the S&P 500 intraday. All right, on December 31st, 2013, the S&P hit a high of 1849.44. All right, on Wednesday of last week, it peaked above that high, hitting 1850.84. So basically about $1.40 higher. All right, that was intraday. So intraday, it made a higher high. And by the end of the day, it was pushed back below and closed back below those December 31st high levels. So when I say the market couldn't close at a new all-time high, that's what I'm referring to. It made an intraday high, and then it was slammed back down. All right, and this is probably to most of you guys are scratching your head and saying, well, who really cares? What's the big deal? But I am telling you, when you get into the hardcore market side that I'm into, the technicals of this market, everything that you need to understand to avoid the Wall Street nonsense, that is a huge deal. And I was on the radio throughout the week saying, guys, this is big, this is big, this is big. Watch it. All right, if we close above those all-time highs, that's bullish for the market. As long as you stay below, I am in cautionary mode here. So ultimately, by the end of that Wednesday, we closed below, and I said it Wednesday afternoon on my short segment at 5:53 in the afternoon. I said, guys, I'm still bearish because of this. And what happens to the market the next 2 days? Market falls. All right, S&P on Friday, I think, was down about 7 points, and that's because, how did I know that? Well, it's just that simple, because we didn't close at a new all-time high. So going into this week, that's all you need to care about, in my opinion. I'm going to still have a negative bias on this market. I gave you a lot of cautionary flags last week, which we'll go over in a little while. But this week, all you need to watch is the all-time high on a closing basis. So really what I'm looking for is a close above Wednesday's high of 1850.84 on the S&P 500. If you do that, be in a neutral to bullish stance on the market. All right, if you can't do that, then keep the negative, keep the cautionary tone on this market. It is huge, guys. I know this seems like a pinprick one way or the other, but I'm telling you right now, it's psychological. And the markets are just it's all about psychology in the market. All right, why do stocks go up? Well, because people have emotional reactions that they think they're worth buying, and so they buy them. Why do stocks go down? Because people get fearful and they sell them. The stock market is all about emotion. That's the only driving force. All right, in 2007, PEs were, they weren't outlandish. They were kind of right where they are now. All right. People thought they were decent buys, and then all of a sudden the financial collapse happened, and everyone said, holy cow, they're not a good buy. And then all of a sudden in 2009, PEs were super low, and no one wanted to buy stocks. Yet the stock market's gone up 150% on the S&P since then. So my point is, fundamentals like PEs, which is price to earnings and so forth, they mean very little because the market is more an emotional being. All right, has its ups and downs emotionally, and that's what causes price fluctuations. So to get a true view of that, we need to look at the stock market. So going back to the S&P 500 high here, all right, and what we're looking for there, think about it in this terms. All right, when you're looking at a market, all right, if you're looking at anything, if I'm going to the store or if I'm playing, I don't know, did you guys ever play Capture the Flag when you were younger? That game where you had two teams and then there was a line in the middle, and if you thought you could run without getting tagged, you could run across and grab the flag and bring it back. I mean, hopefully a lot of us when we were younger, we played that game. It was a great game. In any case, the market, when it's able to peak above a previous high but not stay there, is a market that is scared they're going to get tagged if they cross that line for more than a split second. So when I look at Wednesday's market action, where it just peaked above intraday and then backed off, I look and compare it exactly to that. So when the market's able to bust through and just go, the market's not fearful. The market can go higher because there's no one that's taking profits. There's no one that, and obviously when I say taking profits, I mean institutional base. That's the big boys. And the market can just go and go and go. As soon as you have a situation where you see a market peak above a previous high, especially when we're at all-time highs here, and then back off very quickly, well, that's telling you that the market is not confident, that something's lurking out there. All right, and you can think about it like this. All right, the little guys are buying. We know that, and I'm going to talk about that in a couple of minutes. But the little guys are buying the market. We know that because money flow into mutual funds is at record pace right now. Margins, which I'll talk about shortly, at record pace. And margin, by the way, is the small investor borrowing. Think about how scary that is, borrowing money to invest. And when did margin? When was the last time margin was at all-time highs? 2007. When before that? 2000. Think about that. Dot-com bubble collapse in 2000, 2007. We had, obviously, the financial crisis beginning. Margins at all-time highs. Mutual fund inflows are at huge highs right now. And when the market has that, meaning the small investor jumping in, and it can't get above more than for an intraday blip on the screen, it tells us that there is institutional unloading or what we call distribution out there. All right, so in any case, that's last week coming into this week, and that's the inside track for last week, guys. That's not what you heard on the various media outlets that spew their economic and financial data. This is the inside track of what a pro and what the pros are looking at that they don't want you to know they're looking at, and that's why you can see the institutional selling when you look at it from my perspective. All right. In any case, going back to the charts here and going back to this coming week now, we have to start looking at earnings. All right. Earnings last week, honestly, I think so far they've been atrocious. Absolutely atrocious. Did anyone see Best Buy last week? Best Buy down 30%. Lululemon the week before. Bed Bath Beyond. Elizabeth Arden last week. All of these stocks getting crushed by 10, 20, 30%. And these are all retailers. All right, there were a couple retailers that performed decently, but, you know, we're talking about like Macy's. All right, so Macy's did well, but Sears Holdings, Sears got crushed. Best Buy got crushed. Lulu got crushed. So once in a blue moon, you're seeing one performing well. But for the most part, these earnings are poor. And those are the retailers. All right, the one thing on the retailers I just want to point out here is that coming into this week, you have Coach earnings on, I think, Wednesday morning. Now, the difference between Best Buy and some of these other ones, Elizabeth Arden and so forth, versus Coach is a high-end retailer, right? I mean, so the big question is, and this strangely enough, this all relates back to the Federal Reserve, which we'll get into a little bit later, but the lower-tier retailers, they're doing poorly. While I'm going to be watching closely to see if Coach does well. If Coach does well, what we're going to be seeing in the future, and what's very clear at that point, is that there's a divergence between high-end retailers and anything that's not. And basically, what does that mean? Well, it means that the stock market has been driven to all-time highs by the Federal Reserve and them printing money. And who's benefiting from that? Think about that. Who's benefiting from the stock market going to all-time highs? Oh, well, really, anyone with a lot of money invested. Well, does the middle class and the poor have a lot of money invested? No. Well, where do the middle class and the poor shop? Well, they shop at the lower-end retailers. Where do the rich shop? COH, Coach. So that's going to be some little caveat here that I'm curious to see. And again, it almost makes sense if you think about it. I mean, the main benefit to quantitative easing, which is the Fed printing right now $75 billion a month, but they've printed almost $4 trillion over the last 5 years. The main key here is that the institutions, again, and Federal Reserve have driven this market up, and who's the beneficiary? And again, guys, we're going to go into break here on 8:20 a.m. News. This is In the Money Stock Market Action. I will be right back.
Now back to In the Money Stock Market Action on AM 820 News. Here's Gareth Soloway.
Alrighty, guys, welcome back here to In the Money Stock Market Action. Again, my name is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. Just a reminder, you can call in if you have any questions. I have a couple emails coming in, which we'll get to in a few minutes. The number, again, is 866-977-4820. Come to me with your stock questions. You have a stock that you're in, you have a stock that you're curious about. I'm more than happy to do my best to give you inside analysis. All right, and again, we're not going to be looking at the normal things that the average person would look at. We're going to look at the inside charts. What are the charts telling us? Because that's the true picture. That's how you get away from the nonsense of Wall Street. All right. Number one that I want to discuss right now is my segment that I began last week with, which is, would it shock you to know? So I'm going to reveal a couple things right now about the market that I think are fascinating, that in their own way give us insight into this media juggernaut that is the Wall Street picture and how they're influencing the average investor to put money in the market, probably when they're not at the best position to, or they're not supposed to. All right, first off, this is something I have to give credit to CNBC for, and Carter Worth on CNBC. I found it fascinating, this segment, and I wanted to relay it to you guys. All right, so again, would it shock you to know that at every major top in the market, there has been a major Wall Street movie released? All right, and let's just go back to 1987. We all know in 1987 there was a big stock market crash, right? In 1987, the movie Wall Street with Charlie Sheen was released. Michael Douglas, Charlie Sheen, great movie. All right, so again, 1987, that movie's released, stock market crashes. All right, in 2000, when the tech bubble, the dot-com bubble collapsed, and we saw the NASDAQ go from over 5,000 to about 1,100 in that range, Boiler Room. All right, Boiler Room was, released. And that is shocking to me as well. I mean, just think about that. So, again, does this mean that we just got a movie released called The Wolf of Wall Street and there's something on the horizon? That's a possibility here. All right, let me just talk about one more. In 2007, right? I mean, in 2007, we had a big fall. What was released? The next Wall Street movie, the sequel to it, Wall Street Never Sleeps. All right, and again, in 2000, right at the end of 2013, 2014, The Wolf of Wall Street was just released. All right, now one other scary thing, and this shocked me more than anything. All right, there was another time when a movie was released called The Wolf of Wall Street. All right, it's not the first time that title has been used. When was that title used? 1929. All right, put that one together. Is that a little on the freaky side? So in 1929, a movie by the name of Wolf of Wall Street was released. All right, last week in my show, I showed you, or I talked about a chart of the Dow Jones Industrial Average over the last couple years, and the Dow Jones Industrial Average, same chart from 1928 to about 1930. The charts are identical. And in 1930, the markets fell about 30%. And again, Wolf of Wall Street right there before it in 1929. And here we are, 2014, Wolf of Wall Street. All right, guys, we got a caller on the line here. Craig from Hernando. Welcome, Craig. How can I help you today?
Hey, how you doing, guy? About a month ago or so, I was listening to a radio show, and there was a guy talking about a couple of analysts that he had heard talking about this particular equity I'm going to tell you about. I'm just going to give you an outline of this thing. He was saying that a couple of analysts he heard saying that they expect us to be the next Apple of China. Of course, I always put a red flag against saying I hear like that in the radio, but that's okay. So it's going to be China's version of Apple. Anyway, the stock was around $1.40. Then after he said that, the thing started chugging up. I'll give you the stock so you can look at it. It's CNTF.
CNTF.
Charles Nancy. Yep. Yeah, Charles, Nancy, Tom, Frank. Yeah, it was around $1.40. Then last week, I think it closed up to about $2.16 closing price. Now it's fallen back some. But I've looked at the chart over the past, good God, I don't know how many years, and it seemed like it's been pretty flat or done absolutely nothing.
Yeah, I just brought up the chart as you spoke about it. I'm semi-familiar with this. I do trade sometimes the Chinese small caps in our.
That's a micro cap, isn't it?
Yeah, it's definitely on the micro cap side. And the one thing about Chinese stocks you always want to be aware of too is if you do decide to invest a little money in any small China stock and really any small cap out there, but especially Chinese stocks, always be aware that fraud issues have been rampant in China. Now again, I'm not saying that this one has that by any means, because I think that for the most part this has withstood that test of time where no one's really made those allegations. But just obviously, if you do decide ever to invest in a small stock like this, always invest small money, right?
What's your thoughts on this one? Because, you hear this stuff about this stock's going to eventually down the road be the next Apple of China. In other words, they're expecting this thing to skyrocket. But short term, I obviously not done a whole heck of a lot. But what's your thought on this thing going out?
I would say I'm just looking at the chart, and right now, again, just over the last month or so, it's run up from about $1.30, $1.20 to about $2 as of close.
That's when that guy said that.
Yeah, so right off the bat, to me, as an investor now, I would definitely at least wait for it to pull back. I'm not saying that it's not a good investment, but what I'm saying is right here, I wouldn't do it. Whenever you hear stuff about, they're the next Apple, always take it with a grain of salt.
That's why I preface it with a red flag.
Exactly.
But I'm not saying these guys are wrong. I'm always cautious.
Mm-hmm. Yeah.
How's the fundamentals look on this thing?
It really doesn't have much in that way, to be honest.
Yeah.
It's such a small stock. It's kind of one of those. And listen, in all fairness, maybe it is at some point the next big one. But what I would say to you is I love the fact that you said right away red flag, because it means you understand that the hype of Wall Street is out there.
I said that too because I don't want to sound like I'm pushing something and somebody jumps in the thing and gets burnt on. And I'm not saying anybody's going to get burnt on it. I don't want to sound like I'm some sort of guy out there pushing anything, because I'm not.
Yeah, no, totally. And I think our listeners understand that they all have to make their own decisions and so forth. But just looking at it right now, I would say that, again, as long as it's a small amount of money, if you get a pullback, for me, for instance, if this were to pull back, and assuming the markets aren't crashing at that point, if the markets are crashing, stay away from it anyways. But if the markets are still hanging in there and still kind of right around the highs, I would start to get interested at around $1.60 or so.
Yeah, that's what I was looking at.
And there's the 50 MA right there, the 50 moving average, which for people at home, that's a moving average of current or closing prices over the last 50 periods on the daily chart. It's usually known as a very good support area right there. So I would say somewhere in there, if you want to take a stab at it. I just wouldn't pay up here, that's all.
A friend of mine said to me, well, for that price, he says, he just throw a little bit in there. Don't throw your life savings. It's not like it's not like you're buying Apple or Google where you're paying hundreds or thousands of dollars per share. So, it's something you can play with and just throw a little money that you can afford to lose on it,
Exactly. And that's the right way to look at it. Absolutely.
Yeah.
I'm not opposed. And funny thing is, just before the start of the year, I picked up like a bulletin board stock, which I almost never do. And it happened to be a marijuana stock. And we made a couple 100% on it as it went up. But
wow.
The idea was that I remembered hearing that they were going to legalize it in Denver.
You got in a bandwagon.
Yeah. And I was just smart enough to get in. And that's what I try to pride myself on doing, is just getting in a bit ahead of the crowd before everyone else hears that stuff, and it worked out beautifully. So I'm not opposed to picking up small stocks, but one of the things I did on that one, which is relative to this one, is I literally just took a few $1,000 and I just put it in. And for me, that's very, very minor money. I'm trading every day with $100,000+ trading account and so forth, and I got a lot. So I think it's all relative to each individual investor. Whatever you feel comfortable and saying to yourself, if I lose this $1,000, no big deal, then I think it's okay. For me, I'm a stickler for price entry, so I never want to pay up. So for me, I'd still wait for it to pull back a little bit more because I think it will. But yeah, again, as long as you're okay with the risk involved in a small microcap, you're good.
I noticed the volume sure went up exponentially on this darn thing ever since that guy said that. I don't know if it was coincidental or whatnot, but it went up to I think last week to 3.5 million. It's usually about 100,000.
Yeah. And this, believe it or not, when you have a ton of volume on a small cap, that actually is a negative, because what's happening there is a lot of average investors are piling in, and what'll happen is as the stock starts to come down, they'll start selling. They'll get scared and they'll sell, so they can actually push the stock price down even more.
No such thing as buy and hold anymore, huh?
No, especially not when it comes to small stocks, because people have been burned so many times on the small ones that when they get a good gain, they're going to be selling it. But again, doesn't mean you can't at a good price put a little away.
What will drive? Let's talk about the stock, CNTF. What will drive that stock to higher heights than where it is? I mean, what's it going to take to move this thing?
I mean, I would say it's going to take some sort of big contract or something,
Okay.
Which again, and I'm not too familiar with the stock. I've just, seen it a few times and so forth. But, if they were to get some big deal in China, I'm sure that would be a very nice benefit. But again, that's kind of like me picking up a small biotech and saying, oh man, I can make a ton of money if this biotech cures cancer. And hopefully they do, but the odds of that for that one stock are very, very small.
And if it does, it usually gets bought up by the bigger guys, and and they get squelched.
Right, exactly. Yeah, or they'll get bought out, and you might get a nice premium on it. But again, the odds of any one company coming out and you just happen to pick that one company is very, very small.
I'm going to hang up the phone, but if you can you give me your thoughts on China? Because China's kind of been in the background a little bit, but I understand their economy is booming over there compared to ours. And can you tell me what your thoughts are on China going forward? I'll hang up and listen.
Absolutely, Craig, and thanks for the call. I appreciate it very much. So just to touch on China a little bit, guys, it's a great question by Craig and a couple great questions. But China has obviously had a lot of trouble out there. Their economy, it was based quite a bit off of Europe. So when Europe went south recently over the last couple of years, they've really taken a hit. And, their stock market actually is very cheap relative to the U.S. Question is, can they recover? And there's some underlying issues there in their mortgage side and in their financial side that are definitely a concern right now. You have two basic options that I'm aware of in China. One is to go into the big name stocks like Baidu, Sina, SINA, a bunch of those type of plays. And those plays have had such big runs, especially BIDU. I mean, if you look at the stock chart on BIDU, it is just up, and away. So, for me, when it comes to those China plays, there's no way I'm paying up for it. One thing I always stress to you guys is buy something on sale. Imagine you're going to the mall, but instead of going to the mall, you're going into the stock market mall. And, when you walk into that place, what you're looking for is something on sale. All right? You're not going to go to that place where they're selling the jeans and they just marked them up 300% and then be like, oh, yeah, I got a great deal. I paid 300% more on these jeans. I mean, that's silly, right? So, if you're looking at the large China plays, they've already had their run. The Alibaba news, and Alibaba's supposed to come public at some point in 2014. Yahoo's had a major run because they own a bunch of Alibaba and so forth. But I think the large China plays have for the most part, run their way. The smaller China plays, if you could find something, and again, you're using very minimal, and I mean minimal income to put into it, stuff that you're okay losing. Like, imagine if I were to go to the casino and bring $2,000 with me and say, you know what, it's the casino, I'm probably going to lose it. Well, you know, you want to take a shot in a smaller China stock. That's the mentality you need. You could double your money, you could lose your money. But again, if you do a little research, maybe you can give yourself a slight edge, and I stress slight because it is a tricky thing. So overall in China, guys, I think that played correctly through 2014, there will be buying opportunities there. Right now, I do not think there are any. All right, and again, if CNTF pulls back for Craig, you know, if he has some risky income that he's okay with, I think that's an all right situation. All right, so great question there, and I actually just have one more question that I'm going to do before we go into a segment break here. Number one here is coming from Tracy in Tampa. She says, "Hey Gareth, love the show. Can you explain a level 2?" Great question here. All right, I don't know how many of you out there know what a level 2 is, but a level 2 basically gives you insight into the buyers and the sellers in a market. So, for instance, if I'm looking at, I don't know, let's take Microsoft again. If I have a level 2, and you get a level through 2, you can get a level 2 through, you know, E-Trade or Ameritrade and all these things. And just right off the bat, just be aware, level 2s when you're trading large stocks are almost of no use. It's only when you're trading smaller stocks, you know, mid caps and small caps, that it becomes useful. But basically what a level 2 will show you, on one side, it shows you anyone willing to buy the stock and at what price. So imagine if I'm dealing with a $10 stock, and on my left side of my level 2, I see a buyer, John Smith, at $9.99, and then, you know, and again, these are market makers. So, but then below that, I see Tom Jones at $9.98. All right, those people are willing to pay that price for the stock. On the other side, you have what's called the ask or the offer, which is people willing to sell. And on the right side of that, where we have people willing to sell, you have 1001, 1005, 1010. And basically the only time a transaction where you buy or sell a stock and a print goes off, that'll be when those two sides meet somewhere in the middle. So when finally someone on the bid who wants to buy the stock says, "Oh, what the heck, let me just take it right here and I'll pay that 1001. And then he ups his bid essentially to 1001, and the seller was at 1001. The two connect, and a trade goes through. So a level 2, again, just to summarize here, is basically the buyers on one side and the sellers on the other side, and you can see that. It is helpful, again, when you're dealing with small caps and mid caps. But in any case, guys, we're going to run off to a quick radio break here. This is In the Money Stock Market Action on 820 AM News Talk Radio, and I have some more secrets to reveal when we come back.
Here's Gareth Soloway with more In the Money Stock Market Action on AM 820 News.
Welcome back, everybody. Great to have you with me just before we get into some fun football this afternoon. And again, the last segment here of the day, I want to make sure we cover everything. Number one, we're going to go over the last week's top 5 picks. And remember, basically, if I was wrong, I'm donating $100 to charity. The idea here is that if I'm right and you guys make money, I hope you donate some to charity. So we're going to keep a running tab at the end of the quarter. Whatever we have in the pool, there'll be a charity that is the recipient of that. And again, I hope also, folks, that as you're learning these keys, and again, listen, when we're able to make money in the market, it's all about you have to give back a little bit. And, you know, I've always been a big fan of doing that, and I think it's important for us all to do that. So I do recommend, as you learn these secrets, as it helps you make money or save money, you just throw a little bit to a charity out there of your choosing. And, again, I think that's the right way to do it. It breeds good karma. And karma, again, will help us make money in the future and continue on our path to ultimate profitability. So, again, what we're going to do here is go over the 5 picks from last week, and then I'm going to give you guys new 5 picks. And we're going to see how they perform. And really what I'm doing is making it tough on myself because I'm boxing myself into a 1-week period. Right? Basically, in 1 week, these stocks have to move in the right direction. And that means if the market does something I don't expect it one day, I might be out of luck. But you know what? If I'm out of luck, then a charity gets $100. All right? And if I'm in luck and do right, hopefully you guys are donating a good chunk to charity as well. And that's really the goal here, folks. I want to make sure charity benefits regardless. If I, make a bad call, charity benefits. If I make good call, charity benefits even more. All right? So in any case, folks, let's go over last week's pick. Number 1, GLD long, which is gold long. based off of last Friday's close to this Friday, and we did have a gain there. The GLD, which is the tracking ETF, a week ago from Friday closed at $1.20 or 120.26, and this week it closed at 120.93, so that is a gain. So hopefully a couple of you guys made some money on gold. I've really been talking up gold quite a bit over the last couple weeks, as I have been a fan ever since it put in a major reversal pattern on the charts. And a reversal pattern basically means it's been hammered, 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 and then reversed. I'm still a fan of it in the coming week, but I'm not going to have it as one of my plays this week as well. The next play, corn, C-O-R-N, it's exactly what it sounds like. It's an ETF that tracks corn's price. All right, and I gave it to you guys at 31.16, and it did come down a little bit, down to about 30.63. It's actually making a beautiful bull flag, so I'm a huge fan of it this week. But technically, based off of last week, it was down just a little bit, so that means $100 goes to charity. All right, next one, win short. Now, remember, shorting is where you're betting that a stock will go down. So if a stock goes too crazy, like if a stock goes up a couple 100% in a few days, chances are it's going to pull back, right? So the idea is you can make money on that pullback by doing what we call shorting. All right, so I said I thought win was really extended, and it should have a pullback, and sure enough, it continued to go up. All right, so I gave it out at 206.86, and it went as high as, or closed on Friday at 215.17. That means I was wrong, and $100 goes to charity. All right, the next play, which was my last one, I gave one quarterly play last week, which is good for $500. If I'm wrong, $500 goes to charity, but it's at the end of the first quarter, which is the end of March, and that was JCPenney. But the last one that I gave for a weekly call last week was Long Molycorp, MCP. And Molycorp really didn't do much. It popped up early in the week and then kind of came back in a little bit, and it closed essentially flat. I gave it at $5.42, and it closed at $5.40. But technically, that's down 2 cents. So guess what? $100 more to charity. So right there, guys, a charity is going to be the benefit of at least $300 right there. And I will be making that check out at the end of the quarter, and we're going to keep a running tab. So maybe it'll be a few $1,000. Very likely could be a few $1,000 to a charity by the end of the quarter. And just a reminder, again, if you're learning, if you're doing well, over the course of these radio shows and weeks and so forth, I do encourage you to give a little bit of back so that we can all, be contributing to the welfare and the good being of the U.S. here, to any charity if you're choosing. All right, top 5 picks for this week, folks. Let's talk about them. All right, number 1, I'm telling you right now, I think the S&P, based on the fact that the S&P 500 could not close, remember we talked about that earlier on, above the all-time high of December 31st, on Wednesday, I'm saying that the S&P is going to go down. So I believe this week, in the next 5 days, the S&P 500 will go down. All right. As of the close on Friday, the S&P 500 closed at 1,838.70. 1838.70. So it's got to be below that by the close on Friday. Otherwise, I donate another 100 to charity. All right, next one up. I'm going to stick with short on win using the closing price on Friday. I will be flabbergasted if it goes up again this week. All right. In fact, you know what? I'm going to say right now, if I'm wrong this week, it's $200 to charity just for that one play. That's fair. All right. That's what I think. I believe I'd be shocked. That stock has run so much, folks. It's like up 100% almost in the recent, basically in the last year. And we're not talking about a small company anyways. This is a pretty large company. So, the run it's been on recently, especially over the last 2 months or so, has been epic. And I do think that it's due for a pullback. So I'm going to make that a $200 play for charity if I'm wrong. And again, if I'm right and anyone makes money, please donate a little bit as well, so the charity is always benefiting. Next one, I'm going to stick with my long on corn, C-O-R-N. As I mentioned before, it is a small bullish pattern forming on the daily chart off of a major reversal candle. And I do believe, just like gold last week popped up off of that same general pattern, we should see corn as well pop up. All right, so right now, short the S&P, short win, long corn, C-O-R-N. And the last one I'm going to give you is a long on TZA, which is a little bit of a riskier play. And TZA is a triple short ETF that tracks the Russell index, essentially. All right, it's the Russell, and Russell basically is the small cap area. And I believe small caps are coming to a close here. And the closing price on TZA was $16.63. So I believe it will go up from there. All right, so again, Russell, the TZA is a ETF that you would go long on or buy it, and that would be a 3 times short. So you'd have exposure 3 times to the downside. Very risky, mind you. That one's a risky one. But again, I do believe that will head up this week. And the quarterly play remains JCPenney for $500. If I'm wrong, $500 to charity for that one. All right, so we have, again, short S&P, short WIN, long corn, and long TZA. That's 1, 2, 3, and 4 weekly plays. And then we have our one quarterly play, which is JCPenney. All right, good stuff there, guys. Let's see how it goes. And, again, charity should benefit either way. That's the big key here. All right, next up, what I want to talk about here is basically what's going on with me at InTheMoneyStocks.com. I think we need to spend a little time on that. I want to make sure you guys all understand where I come from, what I've done, and so forth. And again, my name, Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. And basically, I grew up in a lifestyle that was not exposed to the markets at all. I really had no exposure to the markets until I was in high school. My parents didn't really have many investments, at least not that I was aware of. We didn't really talk about the markets. And then I got into high school and I joined the financial or the stock market club. It was like an extracurricular club, and we would pick stocks out of just a general newspaper. A newspaper would come every morning, and we'd, I kind of like Disney, or I like, no real reason or rhyme behind it. You would just give it a shot and go with it. And this happened to be in the later 90 period, or mid-90s, when we started to have those major upswings in the market going into the tech bubble. And, I was playing around online. I remember the Yahoo Finance Challenge, which was a free, you weren't using real money, but you just pick stocks, and the computer program would calculate out how much you were making. And all of a sudden, in the tech run in the late 90s, I started to see, holy cow. I was like, whoa, so much money can be made here. All right? And all of a sudden, I was hooked. I said, wait a minute, this is, if you're good at this, you can be making this type of money in the market if you know what you're doing. Now, again, it was during a bubble, so just kind of like now. I mean, you go to the average person on the street and say, hey, did you make money in 2013? They're going to put, yeah, of course I did. Market went up 30%. How did you not make money, right? But at that point in time, I didn't know any better. I just saw, massive fake dollars, mind you. It was all fake at that point, putting into my fake account, and I was like, whoa, coming up, and I just couldn't believe it. And again, just to give a little shout out there, the Waldorf School of Garden City. There's a Waldorf school actually in Palm Harbor as well. So great schools, by the way. Absolutely fantastic education, focusing more on the arts, focusing more on the well-rounding of a child to give them more creative side, which I believe helped me to go on and start InTheMoneyStocks.com and make it as profitable a company as possible. So great stuff there. In any case, once I went to college, I opened a tiny account. I think I put $1,000 in it, and I just played around with it. And it wasn't anything spectacular. I didn't know what I was doing at that point in time. I remember one funny story. I invested in a stock, pharmaceutical product development, PPDI. They've been bought out since then. But, I was in the stock, and it was, this was a lot of money to me, $1,000. And I put all my money in that stock, and I just waited around, and it went down. And it went down. And it went down. And I was down $400 or so on my $1,000 investment. And I emailed the CEO. At that point, you could easily email, or I found the email on Yahoo Finance, and I emailed the CEO. So one morning, after emailing him a few days before, I woke up, I go into the, bathroom, and, I just was brushing my teeth, and all of a sudden I got a call. All right, and I got a call, and my roommate came in, and he said, hey, listen, someone's on the phone. I said, hello, with a mouthful of toothpaste. And he said, hey, this is the CEO of Pharmaceutical Product Development. And my mouth just dropped open. And from that point on, I said, listen, I can do this. I can be involved. And I've gone on to make In The Money Stocks a very profitable company, teaching you guys the tricks of the trade. So come to InTheMoneyStocks.com. Take the 7-day free trial. Again, this is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com, signing off this week from In The Money Stock Market Action on 820 AM News Talk Radio.